नई गाड़ी या क्रूज की सवारी?
हाँ?
और इसके फ्यूचर की तैयारी?
कौन सा सपना स्किप करूं?
सर जी
स्किप नहीं सिप करो।
सपने स्किप नहीं सिप करो।
मतलब?
SIP के साथ।
कैसे?
जितने सपने उतनी SIP, जैसे सपने वैसी SIP। सिंपली विजिट kotakmf.com/Mr. SIP और सीखो SIP के साथ कैसे हो सकते हैं आपके सपने पूरे सिस्टमैटिकली।
और आप?
म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
Good afternoon, everyone. What you saw is our investor awareness program for popularizing SIP. We also want to thank you for very good response to our NFO Kotak Special Opportunities Fund. It had more than 100,000 applicants and it collected about 2,200 crore. Coming to our usual monthly presentation, if we look at global economy, today pitch has changed from IPL to World Cup T20. Pitch have changed. Earlier, there was globalization. Now there is protectionism. Earlier, there were zero interest rates and government spending money. Now there is higher interest rates and government curtailing fiscal stimulus. ESG has become an important norm. India versus China, well, the pitch is totally different. One autocracy, another democracy. One had advantage of undervalued currency. One could violate IPR rules, regulations, and one which had focus on execution, being autocratic country. If we look at inflation numbers around the world, they have all started coming down, and across the world now inflation numbers are little above the target levels of central banks. The shipping costs have started increasing thanks to disturbance in the Middle East, but hopefully it's unlikely to impact inflation in a meaningful manner. Manufacturing, which had corrected during COVID and bounced back thereafter, witnessed steady decline over a period of time. But in last 9 or 10 months, it has started bottoming out and now rebounding as growth has started taking shape. The household income has continued to rise across the globe as inflation came down, and that should support consumption. Very few people will know this, but for the first time in 3 decades, Japan's nominal growth has outpaced China. This shows that inflation is coming back in Japan, whereas deflation or lower inflation is setting in China. Not that everything is bad for Chinese economy. They have created tremendous investment in manufacturing, and manufacturing in China remains in expansionary zone. Their bugbear real estate also seems to be bottoming out. So undoubtedly, China could be on the way up. The kind of investment China has done in manufacturing capacity is unbelievable. 85 to 97% of solar products are today produced in China. 86% of batteries is produced in China. 3/4 of battery equipments are made in China. 50% of footwear or 12 billion pair of shoes and shoe wear is made in China. They are virtually the largest manufacturer globally. IMF believes that growth will remain stable in 2024, led by countries like India, China, Russia, and US. The Fed remains on hold as they are not getting weaker data needed to cut interest rates. But globally, other central banks have started cutting interest rates led by European Central Bank and Bank of China. We believe as we move in current year towards the end of the year, December 24, the clamors for rate cut will become much, much higher. Coming to US economy, Fed has done an excellent job in raising interest rates at the fastest pace and at the same time not sucking out liquidity dramatically. After adding 4.8 trillion of liquidity since subprime crisis, they have taken out just about 1.7 trillion. They still have $3 trillion of excess liquidity in banking system. Thanks to these Fed's intervention, probability of US going into recession over next 12 months has declined significantly. The length of time for which Fed is keeping rates on hold is about 12 months. Its average is about 8 months over last 5 decades. Clearly, Fed is waiting and watching before rushing in. Partly why Fed is behaving cautiously is the inflation trajectory. Between 67 to 85, inflation moved in a certain trajectory, peaking out in the 80s. And between 2014, inflation trajectory is eerily similar to what happened between 67 and 85. Will inflation start mounting back as there are geopolitical risk in Middle East like they were in the 70s and 80s? This is the reason why Fed is behaving hawkish. As of today, Fed is on hold. Current Fed futures indicate one rate cut in CY24. Mind you, market was expecting rate cut in June 23, July 23. Now it is expecting just one rate cut in December 2024. One more factor which will influence yields is who wins US election. President Trump will be fiscally more profligate. President Biden might be fiscally more prudent, and that will be in relative terms. Clearly, US election also will have a role to play on interest rate cuts. Undoubtedly, Fed is cognizant that US growth is driven by large amount of debt, and current debt to GDP ratio for US government is almost hovering at 125%. While the household America and corporate America is deleveraged just like India, the government of America is leveraged significantly. The estimate of Central Budget Office of US Treasury is assuming that by 2049, US debt to GDP ratio will be upwards of 180%. There's a steady and sharp increase in debt as a percentage of GDP as healthcare and pension liability comes to fore. While broadly US economy has been showing strong traction, labor markets have been resilient, the credit card defaults have reached highest level since 1991, showing K-shaped recovery in America. The US household debt service ratio has also gone back to pre-COVID level, and undoubtedly this is something which Fed will be carefully watching. In this strong economy but slightly uncertain future, equity markets have witnessed robust flows, and that's keeping S&P 500, Dow Jones and Nasdaq near all-time high level. Partly, S&P 500's performance is driven by Magnificent Seven stocks, which is Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. Their profits and market cap has risen significantly, whereas rest of the 493 companies haven't really achieved much. S&P 500 on a cyclically adjusted PE ratio basis is looking expensive relative to historical valuation. All this has resulted into Fed remaining cautious and sometimes confused. Some time back, around similar time, one Fed governor urged caution on rate cuts, saying war on inflation is not over. One gave a cautious guidance that there is one rate cut in 2024. Another Fed governor said there will be 3 rate cuts as inflation battle is over. 3 people from the same organization virtually took 3 different paths. One for rate cut, one for hold, and one for rate hike. This shows how complicated American economy is. Indian economy so far is doing extremely well. It's behaving like oasis in the global desert. Headlines by and large have been positive, with India's current account balance turning into surplus last quarter. FY24 GDP growth at 8.2% was higher than expectations. Beginning of the year, people were at 6% big figure. End of the year, the real number came at 8% big figure. This strong momentum is continuing in first quarter FY25. There is about 27% increase in advance tax collection for the June deadline to about 1,48,000 crore. Throughout the first quarter, there is increase of about 24% in corporate tax and 32% in personal income tax. People will pay tax only when they are making profit. Manufacturing PMI remains elevated, giving good indication for the future. Whereas domestic activity did suffer during summertime because of excessive heat, now with rains coming, this problem will be behind us. The government continues to lead in investments as a percentage of GDP. Thanks to the execution on ground, impact of this investment is even better, and market expects this trend to continue move upwards over a period of time. This year, there could be a boost to infrastructure spending. as RBI has delivered 1,23,000 crore additional dividend to Government of India. Corporate capex was on the back foot. Now it seems to be picking up as election uncertainty are behind us. We believe going forward, corporates have ability to spend more on capex as depreciation is now much higher than the capex. The capex divided by depreciation ratio is now hovering at one of the lowest level. One more sector which will benefit economy is real estate. Since COVID time, real estate activities have picked up across India in terms of sales. Indian households have witnessed slightly higher level of debt, but their overall savings remain reasonably good. Compared to rest of the peer group, Indian consumers are in a far better position. While our goods exports had a slow start in picking up market share, our services exports have jumped significantly, and today we have almost 5% market share in services exports. Our current account deficit narrowed significantly, and in the fourth quarter, we had positive surplus. Some good signs about Indian economy is decline in demand for Manrega. As people are finding better opportunities, they are demanding less and less of Manrega activities. Tractor sales, after declining in the month of April, have bounced back in the month of May. Let's hope and pray this is harbinger of rural economy. Some of the negatives for Indian economy: recent spike in oil prices. It's almost up 10% since September 23 low. And the near-term spreads on oil does indicate that oil prices are likely to remain firm in the near term. Rain gods have been pleasant about India. From deficit, India has witnessed positive surplus on rain. More importantly, spatial distribution of rain also is reasonably good. And a city like Mumbai, which was witnessing much lower activity of monsoon in the first few days of July, it seems to have picked up. Our economic fundamentals within emerging market continues to look good, far better than most of the peer group in various parameters. Converting this strong economic foundation doing better than peers into equity markets? Well, equity markets are near all-time high. The market cap is now in excess of $5 trillion, but so is our GDP and corporate profitability. Nifty 500 companies PAT at about 14 lakh crore is all-time high, and it has witnessed 35% CAGR over last 4 years. Our corporate profit to GDP ratio has moved from 2% to 4.8% in last 4 years, and it is now higher than historical average of 3.7%. As long as this profitability trend is maintained, the downside of the market will remain limited. The quality of corporate profit is even better. There was a time in 2008 subprime crisis, corporates were showing profit but not cash flow. Now corporates are showing profit as well as free cash flow. They can do what they want to do with this liquidity. We believe Nifty 50 earning per share for FY25 this year will be 1143 and next year will be 1331, indicating 16.5% increase in earnings. NSE 500 will move from about 892 to 1042, clocking earnings growth of 17%. If we look at Nifty's market cap vis-a-vis profit compounding, there are sectors like BFSI where between 19 to 24 profit compounded at 36%, but market cap compounded only at 15%. It shows BFSI remains on the cheaper side, undervalued side. On the other hand, capital goods company delivered 9% growth in profit, but their market cap went ahead by 22%. It shows that certain sectors like capital goods are fairly priced or are pricing in almost all the optimism. Metals continue to remain very, very interesting. Profit growth is about 8%, but market cap growth is about 20%. Undoubtedly, when we look at these figures, it gives confidence that banking seems to be undervalued at this point of time. Domestic flows continue to remain strong, and domestic investors are behaving fairly maturedly vis-a-vis FPI news, FPI selling. The domestic ownership of Indian equity between mutual funds, insurance companies, and retail now exceeds FPIs by a margin. Looking at their underweight position in India, most FPIs have turned buyers in the month of June and July. Thanks to our performance, our weight in MSCI emerging market has constantly increased, and we believe it will go a notch above if MSCI decides to ignore HDFC Bank in MSCI index at full weight. Market cap to GDP ratio at 136% is higher than average of 83% for the period. Based on this, it looks like as if our markets are expensive against average of 83%, current market cap is 136%. But not only market cap, the profit also has risen. Our contribution to global market cap is now about 4.2%. Historical average has been 2.7%. Undoubtedly, like in local market, global market also, we are trading at a premium based on our growth potential. One way to look at this race is that as India's share in global GDP started moving up, so did India's market cap. Today, India's share in market cap is 4.2%, and share in global GDP is about 3.6%. While markets have moved, profits have also moved, and which is why Nifty continues to trade around historical average. Historical average is 18.5% and current P ratio is 20%. Some of this has happened because B2C companies like Trent have entered Nifty and they trade at much higher valuation than B2B companies which have gone out. In small and mid cap, valuation premium is on the higher side at 37% and 41%. Will recommend people to be cautious on small and mid cap, considering the significant premium to historical average. If we look at index valuation, Sensex is trading around its 10-year historical average 24 versus current P of 24.6. Small caps are at a slight discount. Auto is now at a premium. Banks are at a discount. Capital goods is at a premium. Consumer durable is at a significant premium. FMCG is virtually flat, and so on and so forth. As I mentioned, Nifty's valuation look little bit on the higher side as B2C companies like Trent enter and B2B companies continue to go out. Overall, Indian equity market is trading in a unique territory relative to other markets in terms of better return on equity as well as lower price to book in terms of valuation. One concern for the market is heavy selling by promoters. In the 1st April to 30th June 3 months, total selling by promoters was about 63,000 crore. QIP OFS preference issue put together, total selling is about 1,20,000 crore. No wonder ownership of FPIs and private promoters have declined from about 42% to 38%. The small and mid caps contribution to overall market remains stable at about 37%, and top 100 companies contribute about 63%. Number of companies which are trading at 50 plus multiple, they are up 10 times. And today there are more than 104 companies in Nifty 500 which are trading at 50 times multiple. The same thing is pictorially represented where percentage of stocks in mid-cap 150 above 60p have increased significantly over last many years. Our call on equity remains neutral weight with some overweight on large cap and some underweight on small cap. We are practicing what we are preaching. Balance advantage fund and multi-asset allocation fund both are having equity allocation in a fair range of 40 to 60%. We are neither super overweight nor super underweight in terms of our allocation to equity. Going forward, sectors like banks and FMCG should do well. On a 5-year basis, banks have delivered lower return. FMCG is also similar. We believe between bank and FMCG, we should be able to outperform market in the days to come. In our portfolio, Kotak Consumption Fund and Kotak Banking and Financial Services Fund could provide opportunity to ride FMCG and banking sector. Overall, we believe markets will depend upon when does Fed cut rate, what happens to energy prices, how is the budget, is there any change in capital gain structure in the budget, and what happens on the geopolitical side. If all these events are positive, we will see market rising steadily. If some of these events are negative, there could be correction in the market. We believe thanks to the growth and domestic flows, correction in market will be short-lived and not very deep unless until something fundamentally changes over here. Our small cap fund, which we had shut for subscription, is now open for subscription from July 2nd. We had to shut these funds ahead of election uncertainty. Now we are opening this fund for subscription. We expect people to come with a longer term time horizon as small caps have run up a lot. We also expect investors to invest with moderate return expectation. What we saw in small cap over last 3-4 years, that's undoubtedly on a very, very higher side. And that kind of return may not be sustainable going forward, and hence recommendation to invest with long-term horizon and moderate return expectation. If we look at equity investment opportunity, SIPs continue to be the flavor of the season. Most of our funds on a rolling return basis has delivered value to customers by outperforming benchmark indices in equity as well as hybrid funds. On a point-to-point basis, bearing few exceptions like emerging equity on a 3-year basis and FlexiCap on a 5 and 7-year basis, we have outperformed benchmark indices and added value to our customers. The same trend continues across our equity and hybrid funds. If we look at just SIP performance, again, adding value to customers through SIP investment has continued in Kotak Mutual Fund. From a fund point of view, 3 funds for you to look at. Kotak Equity Opportunities, a blend of large and mid-cap fund. Kotak India EQ Contra Fund, a value-biased fund. And Kotak Multi-Cap Fund, which invests across large, mid, and small. Another fund of ours, Kotak Quant Fund, has done exceptionally well. And here it has generated alpha of almost 18% in 6 months and 24% since inception. Coming to debt market, as I mentioned, there are many central banks which have started running ahead of US Fed in cutting rates. Switzerland, Brazil, Chile, Colombia, Mexico, Canada, European Central Bank, Sweden, Switzerland. There are many people who are cutting interest rates on policy to support growth. As mentioned earlier, debt FPIs on India's inclusion in JP Morgan government bond indices have started investing in India. CPI inflation has further eased and it's now below RBI's core target range of 4% on the core inflation side. The 10-year government securities by and large have remained stable. RBI has managed liquidity quite nicely. Overall, we believe this is time to accumulate duration. Maybe next 3-6 months, we won't see policy rate cuts, but thereafter Fed will lead the way in cutting interest rates and will benefit long duration, long debt maturity papers. Overall, we believe this is time to pick up duration as chances of 10-year yield declining further is far, far higher on account of liquidity easing, debt FII flow, RBI pivot, and the budget. Within debt, for low taxpayer, Kotak Money Market Fund, Kotak Debt Hybrid Fund will be appropriate. For someone who wants regular cash flow and who is in higher tax bracket, Kotak Balance Advantage Fund, Kotak Equity Savings Fund kind of funds will be appropriate from a SWP point of view. Coming to gold, we have been bullish gold since COVID time. Barring 2021, gold call has worked well. That's primarily driven by central banks buying gold, and gold's percentage share in global reserves is slowly but steadily increasing. Today, out of central bank's reserve, 49% is in dollar assets, 16% is in euro, and 16% is in gold. We believe this number will continue to increase further. Chinese investors have been buying gold at a rapid pace, both as a central bank level as well as in individual capacity, and which is why we are seeing such a strong gold prices. Gold prices generally get supported whenever US interest rate starts coming down. And we are seeing a scenario where gold prices seems to be discounting. We believe current gold prices movement is partially discounting potential drop in US interest rates.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.